This is part 4 of our video series with respect to our example question LSL Plc, which is a company, and we are journalizing the transactions for this company. Now, we would have left off in our previous video where we started looking at this transaction on the 17th of July, where we said you issue 4,000 ordinary shares at a price of $1 per share. And we said that all funds were sent by check. So in this particular transaction here, we're going to be doing a series of calculations in order to determine what we are supposed to record for this particular transaction. Now, let's look here. First of all, they are issuing the shares at $1 per share. But we must go back to the beginning of the question where it stated that LSL Plc was formed on July 1st, 2012, and it was formed by issuing ordinary shares at a par value of 75 cents. So the par value of the share is 75 cents. So when we want to calculate the value that we're supposed to be recording for our shares, what we do, as was stated in your introductory video on this topic, we say that the first thing we're going to do is to work out how much money that will be raised from the issue of the ordinary shares. So we're going to calculate how much money that will be raised from the issue of ordinary shares. So total value of issued shares, that's what we're going to look at. So it's 4,000 shares, and we're going to multiply that by the issue price, which is $1, which gives us $4,000. So that's the total value of the shares that are being issued. And after we worked out the value of the total amount of the value of the shares that are being issued, our next step, we are going to separate the par value of the shares from the share premium, because the par value is 75 cents and they're issuing at $1. So that means that they're issuing at a premium. And we said in our introductory video that a share premium is the difference between the par value of shares and the price at which they are issued. So that means the share premium is $1 minus 75 cents. So the share premium is 25 cents. That's what the share premium is. We also stated that the shares are issued, when it comes to a share premium, the shares are issued at a higher price than their par value. And when this happens, we see that the shares are issued at a premium, and you have to record both the nominal value or the par value of the share and the share premium in your journals. So here, how much we're going to calculate now. What is the value of our ordinary share capital? So ordinary share capital would be equals to 4,000 shares multiplied by the par value, which is 75 cents. So 4,000 shares multiplied by 75 cents gives us $3,000. And now we are going to calculate the share premium. So share premium would be 4,000 shares multiplied by 25 cents, because we said that the premium was 25 cents. So that is $1,000. So now we are going to record in our cash book, because that this money was received by check. So because it was received by check, we are going to record it in our cash book. So in our cash book on the 17th of July, our details, because this is new capital that is coming in for the company. Our details will be ordinary share capital. If it was preference shares, you would see also preference share capital, you would calculate it. It was a check, you would put $4,000. On the 17th, because the shares were issued at a premium, we record the value of the share premium. So share premium, $3,000. Share capital is $3,000 and the share premium is $1,000. Right, so that is our calculations here. We could have also omitted this step here where we did this first, and we could have gone straight and calculate the value of our ordinary share capital, which would be the shares that were issued multiplied by the par value of the share. And then we could have gone and calculated the share premium, which would be the shares that were issued multiplied by the amount that is the premium, and that would give us our share premium. And the two of those figures together gives the total amount of money of the share capital raised by the company. So that's our transaction with respect to our ordinary shares that were issued. So I trust that that was simple enough that you can understand how to calculate your shares issue. And if it was preference shares issue, you would do the calculation in the same manner. Okay? But you must look at our video where we talk about accounts of limited companies, where we looked at calculating the dividends for ordinary shares using a percentage, where we also look at calculating the dividends using a rate per share, and calculating dividends when the shares are issued at a par value lower than $1, and also calculating dividends on our preference shares. Okay, so you must watch that video because it is very informative and it will help you to understand some of these concepts. So let's continue our transactions. Now on the 20th, they paid wages for cash of $600. So that's a cash book transaction. So we go there, pay wages. So we go to the credit side, and the date is the 20th of July. Wages, that's what they paid. They use cash, so we're going to record it in the cash column, and that is $600. Then on the 27th, they receive a check they receive rent by check from a tenant, so they're receiving money of $1,000. So you go to the debit side, 25th of July, rent received, $1,000. And then on the 27th, it said purchase a new piece of equipment valued at $3,395. So we purchased a piece of equipment valued at $3,395, and we are going to record this transaction here. Because it's purchased on credit, we're going to record it in the general journal. So let's record the value of the new equipment first. So here we go here, and that is on the 27th of July. We are going to debit equipment for $3,395, and we're going to credit JAD Inc. for $3,395 to show the purchase of this equipment. So this is, if you had to do a narrative, it would be bought equipment on credit. And if I also had to do a narrative for my opening entries, I can state opening assets, I can say assets and liabilities at July 1st to open a set of books. So if I wanted to do a narrative for my opening entries, I can say assets and liabilities at 1st of July to open a set of books. And if I want to do a narrative for this equipment purchase, I can say bought equipment on credit. So this is the value of the equipment that was bought, $3,395 from JAD Inc. And then they said a down payment of $2,500 was paid by check. So we can record this payment to JAD Inc. by check. So we go to the cash book, and on the 27th of July, we say JAD Inc. and we put the $2,500 under the bank column. Then we have our transaction on the 28th, which it said pay $450 of the cash into the bank. So you're taking money out of the cash account and you're putting it into the bank account. So we are going to go to the bank account on the 28th of July, and we're going to debit it for $450. We write cash here because that's where the money came from. And we're going to go to the credit side on the 28th, and we're going to credit cash. But this money went to the bank for $450. So we're taking it out of cash and we're putting it into the bank account. And then on the 31st, final transaction, we pay dividends of $800 by check to the shareholders. Now in this one here, they give you the exact amount of money that was paid to the in dividends to the shareholders, and you didn't have to calculate any dividends. So therefore, we record that here, 31st of July, dividends, $800. And that completes our transactions for LSL Plc. So what we're going to do now, we are going to balance our cash and bank. We will total our discount column. So our discount column is total, and the total for our discount allowed is $45.30. And the total for our discounts received is $75. So the total for our discount received is $75. So remember, you total your discount columns, the total discount allowed, discount received, but you balance the cash and bank. So the debit side of our cash account is $1,500 and the credit side is $1,050. Remember, the debit side of your cash account will always be greater than the credit side. If it is not, you would have done something wrong. So the balance is going to fall on this side at July 31st for our cash. So that will be $1,500 minus $1,050. So the balance for our cash is $450. And when we look at our bank, the debit side is $8,865.70. But the credit side is $9,475. So for our bank, the credit side is greater than the debit side. So since our credit side is greater than our debit side, we are going then to the difference will fall here on the credit side of the will fall on the credit side. On the the balance will fall on the debit side of the bank, of the cash book for our bank. So here on the 31st July, balance carry down, bank $9,475 minus $8,865.70, and we have a balance for our bank of $609.30. Remember, if the balance is carried down on the debit side, it is brought down on the credit side, and if it is carried down on the credit side, it is brought down on the debit side. So we will be back and we will continue to look at these accounts in our next video.